In 2021, South Florida condos were gold. 220,000 newcomers chased listings that vanished overnight as bidding wars raged. But just 4 years later, headlines screamed, "Governor of Florida loses it." After skyrocketing insurance, special assessments, and lender crackdowns triggered a full-blown condo market implosion. Suddenly, owners faced HOA dues that rivaled second mortgages, insurance became nearly impossible to get, and entire neighborhoods saw foreclosure rates soar as prices plunged by over 30%. Why did a sun-drenched boom unravel into political chaos and personal ruin? And could anyone have stopped this collapse before it spiraled out of control? The answer begins with the migration wave that set disaster in motion. Florida's population boom in 2021 wasn't just a headline. It was a measurable surge that rippled through every corner of the state. Migration analysts tracked more than 220,000 new residents that year, a net gain that put Florida at the top of the nation for domestic migration. Utility companies processed record numbers of new hookups. The Postal Service logged tens of thousands of change of address requests, each one a data point in a relentless wave of newcomers. By the end of the year, the state's population officially topped 22 million, a milestone that had demographers and local officials alike scrambling to keep up. Nowhere was this influx more pronounced than in South Florida. Palm Beach County alone added 16,000 residents, swelling school enrollment and crowding suburban roads. Miami-Dade and Broward counties saw similar patterns, with arrivals from New York, California, and Latin America fueling the surge. The state's reputation as a haven for remote workers, retirees, and families seeking lower taxes made it a magnet for those looking to start fresh. In the span of 12 months, neighborhoods that once felt sleepy were suddenly bracing for the next moving truck. The data told a clear story. Demand for housing was outpacing anything the region had seen in decades. In some communities, local governments approved emergency permits for new construction just to stem the tide. Real estate analysts pointed to a shrinking pool of available homes, while developers raced to break ground on new condo towers. Even inland cities like Sunrise and Tamarack, far from the oceanfront glitz, saw their condo markets heat up as buyers fanned out in search of anything affordable. The gold rush mentality was everywhere, and for many, the only question was how long the boom could last before the underlying strain began to show. By the fall of 2021, the condo market in South Florida was running hot enough to make even seasoned agents sweat. Inventory had fallen to levels not seen in 15 years. In Miami-Dade, Broward, and Palm Beach, active condo listings thinned to a trickle. Buyers lined up outside open houses before sunrise, hoping to get a jump on the competition. Units priced under $300,000 rarely lasted through the afternoon. Angela Torres, a Broward realtor, remembers one Friday morning when she posted a modest 2-bedroom online. Within hours, her phone lit up with calls and texts from across the country. By midday, 16 offers had landed on her desk, 10 of them all cash, most from buyers who hadn't even seen the unit in person. Some offered to waive inspections, others promised to close in less than a week. Angela barely had time to return messages before the condo was under contract, sight unseen, to a family from New Jersey. Scenes like this played out across the region. In Hallandale Beach, a listing would draw a crowd before the agent could put out a sign. One seller fielded a dozen offers in a single morning, each one higher than the last. Bidding wars were no longer a surprise. They were expected. For every unit that closed, a dozen hopefuls walked away empty-handed. Cash ruled the day. Investors from New York, California, and Latin America snapped up properties with wire transfers and no contingencies. Local buyers, even those with solid financing, found themselves outpaced. Angela wrote 5 offers for the same client in a single week, losing every time to someone who could pay more and move faster. For many, it wasn't about who wanted the condo most. It was about who could outbid and outweight everyone else. The market's fever spread inland too. In Sunrise and Tamarack, condos sold above appraisal, leaving appraisers scrambling to justify prices and buyers willing to bridge the gap with cash. Open houses felt less like weekend strolls and more like velvet rope events. Realtors compared notes on how quickly listings vanished. The question wasn't if a unit would sell, but how fast and for how much, over asking. For agents like Angela, the frenzy was both exhilarating and exhausting. Every closing brought relief, but also a sense of disbelief at how quickly the rules had changed. In South Florida's condo market, scarcity wasn't just a statistic. It was a lived reality, shaping every offer, every sale, and every conversation about what it meant to own a piece of the Sunshine State. The collapse of Champlain Towers South in Surfside on June 24, 2021, sent shockwaves through Florida's real estate and political circles. 98 lives were lost in the early morning darkness, and an entire building reduced to rubble, forced lawmakers to confront a reality long ignored. Thousands of aging condo towers, many with hidden structural flaws, dotted the coastline and the urban core. Within months, Tallahassee responded with Senate Bill 4D, a sweeping overhaul of condo safety rules that would reach into every high-rise community in the state. The new law set a clear, unyielding clock. Every condominium or cooperative building above 3 stories must undergo a milestone structural inspection at age 30, then again, every 10 years. For buildings within 3 miles of the coast in Miami-Dade and Broward, the first deadline came even sooner, 25 years from the date of their original certificate of occupancy. For hundreds of older towers, that meant the countdown ended on December 31, 2024. Associations scrambled to book engineering firms, review decades-old blueprints, and prepare for the first round of inspections in a generation. Senate Bill 4D didn't stop at inspections. It required associations to commission a structural integrity reserve study, identifying the cost to repair and maintain critical systems: concrete, steel, waterproofing, roofs, and more. Perhaps most consequential of all, the law ended the long-standing practice of waiving or underfunding reserves. Associations now had to collect and set aside enough money to cover the full cost of future repairs, no exceptions. For many buildings, this meant recalculating budgets overnight and bracing for a sharp rise in monthly fees. The intent was clear: prevent another Surfside. But the practical effect was to launch an unprecedented wave of engineering reports, reserve studies, and emergency board meetings. In Miami-Dade and Broward, the backlog of buildings waiting for inspections grew by the week. Engineers uncovered widespread spalling concrete, rusted rebar, and failed waterproofing, problems that had been quietly accumulating for years. As the first inspection deadlines approached, the scope of deferred maintenance came into focus, and the financial reckoning for owners was only beginning. Engineers arrived at South Florida's aging condo towers, armed with clipboards, thermal cameras, and a mandate from the state: find the cracks before they become catastrophes. Inspection teams fanned out across Miami-Dade and Broward, some working through weekends to meet the looming deadlines set by Senate Bill 4D. What they found inside the concrete skeletons of the 1970s and 80s shocked even the most seasoned professionals. Spalling concrete, where the surface crumbles away to reveal rusted steel, showed up in more than 40% of older coastal buildings. In some garages, support beams flaked apart at the touch, exposing rebar so corroded it looked more orange than gray. Engineers' reports described water intrusion around pool decks, cracks running along balcony slabs, and failed waterproofing that let rain seep deep into the building's core. A typical line from a milestone inspection: observed advanced spalling and exposed rusted rebar in the eastern garage perimeter beams. Immediate waterproofing and shoring required. Reserve study consultants, brought in to calculate the true cost of repair, delivered spreadsheets that ran to dozens of pages. Concrete restoration alone often topped $1 million for a mid-sized tower. Full waterproofing of decks and roofs added another $500,000. In the worst cases, per-unit repair bills soared past $80,000. Even buildings with only moderate findings faced assessments in the range of $15,000 to $45,000 per owner. Bottlenecks quickly developed. Permitting offices in Miami-Dade and Broward struggled to keep up with the flood of repair applications. Engineering firms were booked out months in advance. Contractors warned of material shortages and labor costs rising 20 to 30% in just 2 years. Some associations waited nearly a year just to receive their first inspection report, while others rushed through emergency board meetings, anxious to avoid missing the state's December 2024 deadline. The backlog grew, but the underlying problems refused to wait. In nearly half of all inspected buildings, engineers flagged waterproofing failures as the top culprit, especially around pool decks, roofs, and garages. Settlement cracks and balcony deficiencies appeared in about 1 out of 10 towers, with the most severe cases requiring shoring and immediate evacuation of affected units. For many owners, the technical language of these reports translated to one thing: a looming, unavoidable bill. Engineers presented their findings at board meetings, often to rooms packed with anxious residents. The message was blunt: pay up, sell at a loss, or risk the building falling out of compliance. As the scope of hidden decay came into focus, the financial shock was only just beginning. In the summer of 2025, the true cost of Florida's condo reckoning landed in living rooms and kitchen tables across South Florida. Special assessments, once a rare emergency measure, became a fixture in association budgets. In Miami, the median assessment hit $45,000 per unit, an amount that left many owners scrambling for options. For some, the shock arrived by certified letter. For others, it was announced at packed board meetings, where tempers flared and voices cracked with worry. Rosa Delgado, a retired schoolteacher living in a 1970s Miami condo, faced a proposal she could hardly believe: a 300% increase in monthly HOA dues. The board's reserve study, required by new state law, showed millions needed for concrete restoration, waterproofing, and elevator repairs. There was no way around it: either raise the money or risk the building falling out of compliance, with all the legal and financial penalties that would follow. Rosa's monthly dues, once manageable on her pension, threatened to swallow half her income. The special assessment, due in 3 installments, totaled more than she had saved in a decade. At the August board meeting, owners lined up to speak. Some pleaded for payment plans or hardship waivers. Others demanded to see the engineer's reports, convinced the numbers must be wrong. Rosa, clutching a folder of bills and Social Security statements, asked what would happen if she simply couldn't pay. The board president read from the attorney's letter. Delinquent owners faced liens, late fees, and, ultimately, foreclosure. The room fell silent. A neighbor whispered about selling at a loss. Another mentioned moving in with family out of state. Stories like Rosa's echoed across Broward and Palm Beach. By mid-2025, the average 2-bedroom HOA fee in those counties had climbed above $1,250 a month, a 50% jump in just 3 years. In buildings with major repairs, special assessments stacked on top of regular dues, pushing total monthly costs well beyond what many retirees or working families could afford. Some drained their savings or cashed out retirement accounts. Others turned to legal aid, hoping for relief. Board minutes from dozens of associations recorded heated debates, resignations, and, in some cases, threats of lawsuits between neighbors. Economists at the Federal Reserve Bank of Atlanta called it an affordability crisis. They warned that these costs weren't temporary. For many, the math no longer worked. Owners weighed impossible choices: pay up, sell at a loss, or risk losing their homes entirely. The next wave of pressure, insurance turmoil, was already building on the horizon. 6 insurance carriers abandoned Florida's property market between 2022 and 2025. Each exit was announced in terse filings with the state regulator. The withdrawals accelerated in the summer of 2025, when United Property and Casualty canceled more than 30,000 condo and homeowner policies in a single month. Letters arrived with little warning, sometimes just weeks before hurricane season. Owners scrambled to find last-minute coverage, only to discover that private options had all but vanished. In less than 3 years, over 600,000 Floridians lost their private insurance, an exodus that left entire buildings exposed and anxious. Industry filings with the Office of Insurance Regulation laid out the causes in stark terms. Reinsurance costs had soared by as much as 40%, fueled by a string of costly storms and a legal system that generated more property insurance lawsuits than the rest of the country combined. Carriers described the business as unsustainable. Some, like United, entered state receivership after failing to secure enough reinsurance for statutory renewal. Others simply stopped writing new policies or issued non-renewal notices en masse, citing mounting losses and regulatory uncertainty. For condo associations, the fallout was immediate and severe. Buildings that had carried the same master policy for decades suddenly found themselves uninsurable. Premiums doubled or tripled when coverage could be found at all, often with higher deductibles and tighter limits. Some associations were forced to accept bare-bones state-backed coverage, knowing it might not be enough if disaster struck. In Miami-Dade and Broward, boards reported annual premium increases from $100,000 to $400,000 or more, pushing already strained budgets to the breaking point. The loss of coverage rippled through the credit system. Lenders began flagging buildings without private insurance as high risk. Mortgage brokers fielded frantic calls from buyers and sellers as deals fell apart at the 11th hour. No insurance, no loan. Fannie Mae and Freddie Mac updated their eligibility rules, requiring proof of full replacement, wind, and flood coverage before approving any new condo loan. Any gap in coverage meant automatic denial. The result? Stalled sales, canceled closings, and a growing sense of uncertainty among owners and prospective buyers alike. Condo boards and homeowner groups lobbied state officials for relief, accusing insurers of abandoning the market and leaving residents exposed. Insurers countered that without fundamental reforms on litigation, reinsurance, and catastrophe risk, Florida would remain too volatile to insure at any price. In the meantime, the burden shifted to owners, who now faced the prospect of paying more for less protection or going without entirely. The insurance gap had become a threat not just to individual buildings, but to the stability of the entire South Florida condo market. By the summer of 2025, the South Florida condo market faced a new and invisible barrier: credit itself. The insurance crisis didn't just raise costs, it froze the gears of lending. Major banks, including Wells Fargo, Chase, and United Wholesale Mortgage, began circulating internal memos that spelled out the new reality for condo buyers. Any building covered only by Citizens Property Insurance, the state's last resort carrier, now triggered automatic red flags. For those projects, lenders demanded down payments of 30% or more if they would finance a loan at all. Fannie Mae and Freddie Mac, the government-backed giants behind most conventional mortgages, added their own rules. Full replacement coverage for wind and flood, plus proof of fully funded reserves, became non-negotiable. Any missing piece meant an instant loan denial. Mortgage brokers, who once boasted of quick approvals and flexible underwriting, now spent their days explaining to frustrated clients why perfectly good credit wasn't enough. It didn't matter if you had a six-figure salary or decades of savings. If your chosen building failed the new insurance or reserve tests, your application went straight to the reject pile. These changes hit hardest in older towers and mid-market buildings, precisely the places where insurance was hardest to secure and reserve mandates bit deepest. FHA condo approvals, a lifeline for many first-time buyers, dropped by nearly 40% in a single year. Mortgage applications for condos across Miami-Dade, Broward, and Palm Beach shrank by 35% according to the Mortgage Bankers Association. Loan officers described a landscape where cash buyers dominated and everyone else faced a minefield of paperwork, delays, and last-minute denials. Interest rates, already above 7%, only added to the squeeze. The typical down payment for a modest unit jumped from $60,000 to well over $100,000 in less than 3 years. For many buyers, the math simply didn't work. Monthly ownership costs, principal, interest, HOA dues, insurance, and special assessments often topped $2,100, nearly double what they had been before the Surfside reforms and insurance exodus. As financing dried up, listings began to pile up. Sellers who once entertained bidding wars now waited months for a single qualified offer. Units sat empty, their prices slashed in search of a buyer who could clear the new hurdles. The freeze on credit didn't just slow the market, it trapped owners in place, unable to sell, refinance, or escape the mounting costs. For the first time in years, the question wasn't how high prices might go, but how much further they could fall before the market found its footing. Deltona, a city once known for its quiet neighborhoods and affordable condos, now finds itself at the heart of Florida's unraveling housing crisis. By the summer of 2025, the numbers told a story of distress. Active condo listings ballooned to a 14-month supply, a figure that dwarfed the balanced market threshold and signaled deep trouble for owners hoping to sell. In some older complexes, rows of for-sale signs lined the sidewalks, and online listings stretched for pages with few inquiries coming in. Prices followed the glut. According to regional MLS data, median condo values in Deltona fell by roughly 18% year-over-year, with certain distressed buildings posting losses of 25% or more. For owners who bought at the height of the frenzy, the math was unforgiving. Units that fetched $210,000 in 2022 now struggled to clear $170,000, and buyers, if they came at all, demanded steep concessions. Appraisers flagged dozens of complexes as high risk, citing deferred maintenance, insurance gaps, and the specter of looming special assessments. The pain didn't stop at falling values. Volusia County's public foreclosure dockets show a 41% surge in filings for condos and townhomes compared to the previous year. Legal aid clinics in Deltona reported a flood of calls from owners facing missed payments, HOA liens, or the threat of losing their homes outright. Some residents tried to negotiate payment plans with their boards, while others simply walked away, leaving empty units and unpaid dues behind. On neighborhood Facebook groups, stories of hardship circulated daily. Owners shared screenshots of foreclosure notices and debated the best way to petition city officials for relief. In one thread, a retired couple described cashing out their 401k to cover a special assessment, only to be hit with a second round of fees 6 months later. Another post outlined plans for a community meeting, hoping to organize a collective appeal for tax relief or temporary forbearance. Local officials, caught between budget shortfalls and mounting pleas for help, faced tough choices. City council meetings stretched late into the night as residents demanded action, moratoriums on foreclosures, emergency grants, or at least a pause on further fee hikes. For many in Deltona, the condo that once promised stability had become a source of anxiety and loss. The collapse was no longer an abstract regional headline. It was a daily reality, reshaping lives and neighborhoods across the city. By June 2025, the political temperature in Florida matched the summer heat. At a press event in Miami Lakes, the governor faced a wall of cameras and a crowd restless with frustration. The numbers had become impossible to ignore. 6 insurance companies gone in 3 years, more than 600,000 homeowners without private coverage, and foreclosure filings in places like Deltona rising by double digits. In the background, condo owners and association board members held up bills and assessment letters, some waving petitions, others clutching folders of unpaid invoices. The governor's remarks cut through the noise of policy papers and expert panels. He condemned insurance carriers for abandoning Floridians at their most vulnerable, calling out what he described as corporate indifference to the crisis. Lenders came in for equal criticism, accused of locking buyers and sellers out of the market with impossible down payments and rigid loan requirements. The governor's voice rose as he described the monthly costs now facing many owners: HOA dues, insurance, special assessments, all stacking up to what, in his words, felt like a second mortgage for thousands of families. Reporters scribbled furiously as he promised to use every executive tool available if the legislature failed to act, vowing not to let bureaucratic gridlock deepen the disaster. Behind the podium, local officials and homeowner advocates nodded in agreement, while industry representatives traded uneasy glances. The governor cited Deltona's plunging condo values and the wave of foreclosures sweeping through Volusia County as evidence of a market in freefall. He pointed to the swelling ranks of Citizens policyholders, over 1 million by summer, and warned that the state's financial backstop was stretched to the breaking point. For the first time, the threat of executive action loomed over the legislative process, with the governor pledging to override stalled negotiations if necessary. The press conference dominated headlines. Editorials debated whether the governor's anger was justified outrage or political theater, but the message landed. For condo owners watching from home, the promise of intervention brought a flicker of hope and a reminder that the crisis had reached the highest levels of power. In the days that followed, lawmakers faced renewed calls for relief, while insurers and lenders braced for a new round of scrutiny. By late 2025, the condo market that once drew hopeful buyers from across the country now sits at a crossroads. Listings continue to stack up in South Florida's biggest counties, with some neighborhoods reporting more than a year's worth of unsold inventory. Sellers who once turned away multiple offers now wait months for a single inquiry, and price cuts have become routine rather than rare. The financing freeze shows little sign of thawing. Major lenders remain wary of buildings covered only by the state's last resort insurer, and the requirements for down payments and reserves have locked out all but the most cash-rich buyers. Real estate analysts warn that the market is stuck in a holding pattern. Too many owners are unable to sell, refinance, or even cover their monthly costs, while would-be buyers are sidelined by uncertainty over future fees and insurance. Expert forecasts paint a sobering picture. The Federal Reserve Bank of Atlanta cautions that the affordability crisis may linger for years, especially if insurance markets fail to stabilize. With Citizens Property Insurance still covering more than 1 million policies, the state's financial safety net is stretched thin. Any major storm could tip the balance, forcing special assessments or triggering a new wave of foreclosures. Economists debate whether the market will find its bottom soon, or if a slow grind of defaults and distressed sales will drag on. Some point to the risk of broader contagion, as falling prices and forced sales ripple outward from the hardest-hit condo complexes into the wider housing market. Others see a chance for gradual recovery if regulatory fixes can restore confidence and private insurers return. For now, the path forward remains uncertain. Inventory climbs, financing remains elusive, and thousands of owners are left waiting, hoping for relief, fearing further losses, and wondering how much worse things might get before they improve. The question lingers: can Florida's condo market reinvent itself, or is this the start of a longer reckoning? In 2021, Florida gained more than 220,000 new residents, sparking a condo boom that drove listings to 15-year lows and created a frenzied seller's market. But in just 4 years, the market reversed. The Surfside tragedy led to strict new safety laws, including mandatory inspections and reserve funding, which pushed association fees and special assessments to record highs. Between 2022 and 2025, 6 insurers withdrew from Florida, leaving over 600,000 homeowners scrambling for coverage, while lenders tightened requirements and sales stalled. By mid-2025, Deltona's median condo price had dropped 32%, with foreclosures up 41% in Volusia County. At a June 2025 press event, the governor cited rising costs and policy losses, threatening executive action if the legislature failed to act. As of late 2025, thousands of owners face unpredictable costs, and financing remains out of reach for many. Whether new regulations and insurance reforms can restore stability is still uncertain. What is clear: Florida's condo crisis was not triggered by a single event, but by a chain of documented causes, and the outcome is still unfolding.